Thank you very much and welcome to MasterView Accounting. This is the fourth video in this series, and my advice is that you watch the videos in a sequential order for easy learning. You may consider subscribing to this channel for free access to these videos. In this video, we are going to look at books of original entry. Previously, we have looked at books of original entry, where we said that they are the first set of books where business transactions are formally recorded. We have gone as far as looking at the first four books of original entry, that is the sales journal, the purchases journal, the sales returns journal, and the purchases returns journal. In this video, we are going to cover the remaining two books of original entry, that is the cash book and the general journal, or the journal proper. So let us start by looking at the cash book. The cash book is a document, or is a book of original entry, where transactions involving cash within a business are recorded. So this is the book which will be used to record cash payments and all cash receipts within the business. So the cash book exists in three forms. We have a 2-column cash book, we have a 3-column cash book, and for those who keep impressed system, we have what we call a petty cash book. We are going to look at each one of them and what it entails. Let us start with the first one, which is the 2-column cash book. It gets its name from the fact that it has two amount columns in either side of the cash book. So the format of a cash book, as we've said, since the cash book is used to handle cash receipts and cash payments, we have two sections, two distinct sections. One dealing with the cash receipts and the other one dealing with the cash payments. The one dealing with the cash receipts is always the left-hand side, and it is called the debit side. And the one dealing with the cash payments is always the right-hand side and is called the credit side. So when you look at the format at the bottom of that slide, you will notice that the left-hand side has the date, it has details, it has cash, it has bank. Then the right-hand side again has the same columns, date, details, cash, and bank. The two sides are separated by a double line. So if you look at each of the two sides, you will realize that we have two amount columns. There is amount for cash, and there is the column for cash, and there is the column for bank. Also on the right hand side, there is column for cash and there is column for bank. So either side has two amount columns. So because in this kind of cash book we have two amount columns, it is given the name 2-column cash book. So the 2-column cash book gets its name from the fact that it has two amount columns on either side of the cash book. Now, let us look at an illustration and see how we record transactions in a 2-column cash book. So, illustration: write up 2-column cash book from the following details and balance off as at the end of the month. So, the year is 2022, the month is May. So, on May 1st, I started business with a capital of 1 million Kenya shillings. On May 2nd, paid rent in cash, 100,000 Kenya shillings. On May 3rd, FRTNO lent the business 5 million Kenya shillings by check. On May 4th, the business paid Bio Molo by check, 650,000 Kenya shillings. On May 5th, cash sales, 980,000 Kenya shillings. On May 7th, Mwangi paid by check, 620,000 Kenya shillings. On May 9th, the business paid Bim Sao in cash, 220,000 Kenya shillings. On May 11th, the business made cash sales, which were paid directly to the bank and the amount is 530,000 Kenya shillings. On May 15th, G. Mugaka paid the business in cash, 650,000 Kenya shillings. On May 16th, 500,000 Kenya shillings was taken out of the cash till and it was deposited into the bank. On May 19th, F. Atieno was paid 1 million shillings by check. On May 22nd, cash sales which were paid directly into the bank, 660,000 Kenya shillings. On May 26th, he paid motor expenses by check, 120,000. On 30th, we withdrew 1 million Kenya shillings cash from the bank for office use. And on 31st, paid wages amounting to 970,000 Kenya shillings in cash. So when we are told to write a 2-column cash book, basically what we have been asked to do is to prepare the cash book with the two sides, the debit side and the credit side, and separate these transactions, separate those transactions which are bringing money into the business, and we record them on the debit side, and we separate those transactions which are taking money away from the business, and we record them on the credit side. So this is how the cash book will look like. So in this cash book, remember, dates are of essence here. Just like any other journal, we are chronologically recording transactions. So every transaction is recorded according to the date to which it occurred. So the title is cash book. So let us look at the debit side. The debit side contains all those transactions which brought money into the business. So the first transaction is on May 1st. And where do we get money from? Capital. When we talk about capital, it means that is money which comes into the business from the owner of the business, the investor who is willing to start that business is the one who is providing the money. So the investor has given 1 million cash to start the business. So that is cash which has come. Then on 3rd, F. Atieno gave us a loan of 5 million Kenya shillings, but he gave that amount by check through the bank. So we received the money as a business, but according to the two distinct columns, we received that money through the bank. So we have to record it in the bank column. Then on May 5th, we made sales of 980,000 Kenya shillings, and the amount was received in cash. So when the amount was received in cash, we record in the cash column. On May 7th, N. Mwangi paid us 620,000 shillings by check, meaning the amount is in the bank. So we go to the bank column, we record. We received the money, yes, but the money, we received it by check. So the amount is in the bank. It is not available in cash. So we go to the bank column, we record. Then on 11th of May, we made sales and the money was directly paid to the bank. The amount is 530,000 Kenya shillings. So we record under the bank column 530 shillings, which was received from sales. Then on 15th, G. Mugaka paid us 650,000 Kenya shillings, but he gave that money in cash. So we go to the cash column and we record 650,000. Then on 16th, there is a transaction which is taking place there. We are receiving money in cash. But where is the money coming from? The money is not coming from outside the business. The money is exchanging position, is moving from one account to another. So we are receiving money in the bank, 500,000 on 16th. But this money came from cash. That is why it is indicated there, cash. And there is a C in front of that cash. And the C means contra entry. Contra entry is where money moves from one account to another within the business. That is, money comes from bank to cash or from cash to bank. When money exchanges that way, The money does not move out of the business, and neither do we receive any money from outside the business. So it is money moving from one account to another. In such a case, we have a transaction which is a contra-entry transaction. Money which was in cash has been banked, 500,000 Kenya shillings. On 22nd, we made sales, and the amount is 660,000 Kenya shillings, and the amount was received through the bank. So we go to the bank column and we record the transaction. And lastly, on 30th, there is money which is withdrawn from the bank and it is brought to cash. So that is why cash is debited with 1 million Kenya shillings. But where is the money coming from? In the details column, we have bank, and in front there it is written C, meaning it is a contra entry, money moving from one account in the business to another account within the same business. So no money comes from outside, no money is going anywhere from the business. So it is a contra entry, money exchanging accounts within the business. So on the credit side, now we have transactions which took away money from the business. What are these transactions? On May 2nd, now we are looking at the right-hand side, which is the credit side of our two-column cash book. So on May 2nd, rent was paid. In other words, money moved out of the business to pay rent. The amount is 100,000 and it was paid in cash. So we go to the cash column and we record 100,000. Then on May 4th, B. Omolo was paid 650,000 Kenya shillings through the bank. So the bank lost money. We go to the bank column and we record 650,000, which was given away to B. Omolo. Then on 9th, B. Msau was paid. So money moved outside, moved away from the business to a tune of 220,000, and that money was in cash. So we go to the cash column and we record 220,000 shillings in cash. Then on 16th, there is the transaction there, which is a contra entry. Money moved. Where did it go to? To the bank. So the bank is within the same organization. That is why it is a contra entry, and the money moved from cash to bank, 500,000. That is why we are recording on the credit side that the cash was reduced by 500,000, and this 500,000 did not move outside the organization, but rather it went into the bank. So that is why if you look at the debit side of that cash book on 16th, there is bank receiving 500,000, but on 16th, on the credit side, bank the cash is losing the 500,000 Kenya shillings. Now let us look at the transaction on 19th. FRTNO was given or was paid 1 million Kenya shillings. On 26th of May, motor expenses were paid to a tune of 120,000 shillings by check, meaning the money left to the bank and it went to pay motor expenses. On 30th, there is another contra entry there where money is leaving the bank and is going to cash. So it is indicated there clearly cash, and it is a contra entry. So the bank is losing 1 million and that 1 million is going to cash. If you look at the debit side on 30th, that is what it is indicating. It is now the bank and it is C. So meaning money left the bank and it came to cash. Then on 31st, wages were paid to a tune of 770,000 Kenya shillings, and the money was paid in cash. So once we have recorded all these transactions, we need to balance off the cash book. How do we balance it off? We find totals. So we find totals of each column. So we find the totals for the debit side, and we find totals for the credit side. So let us start by finding the totals on the debit side. The cash column, the total is 3,630,000. The bank column, the total is 7,310,000 Kenya shillings. On the left-hand side, the cash, the total is less than what we have on the debit side, meaning we had more cash than we spent. We had more cash than we spent. So what is the balance remaining, which we need to add on the left hand side, on the right hand side, so that it can balance? The balance is 1,840,000. That is cash. And for the bank, the balance is 4,540,000. What does that tell you? It simply tells you that if you went to that business and you went to the cash till, you will count 1,840,000 shillings. And if you went to the bank, you will find the money in the bank, the balance, 4,540,000 Kenya shillings. Those are the balances which are carried down to the month of June. So that is why we write there, balance carried down. So if we went to the month of June, what we will do, we will write balance brought down. Brought from where? The month of May. And those balances are debit balances. In other words, the debit side was more than the credit side, meaning we had more money remaining in the business, both in cash and at the bank. So that is how we record those transactions, and that is how we balance them. So let us move to the next one. That is a 3-column cash book. So the 3-column cash book now introduces another amount column, and this amount column which the 3-column cash book introduces is the discount. We have discount allowed and we have discount received. So on the debit side, we will have discount allowed, and on the credit side, we have discount received. So we are going to use an illustration to just understand how we record transactions in a 3-column cash book. So illustration, a 3-column cash book is to be written up from the following details, and then it is balanced off at the end of the period. So the year is 2022, the month is March. First, balance brought forward, meaning the balances from the month of February, is cash 230,000, bank 4,756,000. Then on second, the following were paid, all the following paid their accounts by check. In each case, they deducted 5% discount, meaning if you were owing 100,000, you deduct a discount on that, and the discount is 5% of that money you owe. So let us see how much were they owing these people. So R. Ken was owing 140,000, E. Maura 220,000, R. Laffen 300,000 Kenya shillings. All of them settled their accounts. They paid all the money they were owing the business, but they were allowed to deduct 5% discount. Then on 4th, the business paid rent by check 120,000 Kenya shillings. On 6th, J. Aluoch lent the business 1 million shillings by check. On 8th, the business paid the following accounts by check after deducting a 2% cash discount. N. White 60,000, P. Paul 408,000 Kenya shillings, C. Moses 800,000 Kenya shillings, and C. Moses is the last supplier who is paid. Then there is a transaction on 10th where motor expenses were paid in cash, 44,000 Kenya shillings. Let us continue with the illustration until we get to the end of the month. On 12th, H. Mora pays his account of 77,000 Kenya shillings by check, and instead of paying the whole amount, the 77,000 shillings, she paid 74,000 shillings, and she deducted 3,000 shillings as cash discount. On 15th, The business paid wages amounting to 160,000 Kenya shillings. On 18th, the following paid their accounts by check, and in each case they deducted 5% cash discount. That is C. Mwangi 260,000, R. Wilson and Sons 340,000, and H. Njoroge 460,000 Kenya shillings. On 21st, there was cash withdrawal from the bank of 350,000 Kenya shillings for business use. On 24th of the same month, cash drawings of 120,000 shillings took place. On 25th, the business paid TCOH his account of 140,000 Kenya shillings by cash, 133,000 shillings, having deducted 7,000 as cash discount. On 29th, he bought fixtures by paying by check 650 shillings, and on 31st, he received commission by check of 88 shillings. So how will the three-column cash book look like? So we have that. So the three-column cash book will be showing the amount received, and then the amount paid. So it will have two columns, the debit side and the credit side, just like the two-column cash book. The debit side will show amount received to the business, and the credit side will show the amount which were given, or the amount which took away money from the business. So let us start with the side which brought money into the business. So on the debit side, we have transactions which brought in money, and this is the side where we have the column for discount allowed. Discount allowed means you were making payment, and then you are allowed discount. You are making payment, but you are allowed, or rather you are receiving payment, and you are allowed your clients to deduct some discount. In other words, they are not paying you this money. This is something you give them as an incentive so that they can settle their accounts. So that is what we refer to as discount allowed. It is recorded on the debit side. On the credit side, we have discount received. We are paying suppliers, and they decided to advance discount to us as an incentive so that we can make payment. So such discount which is allowed is recorded on the credit side of the three-column cash book. So let us look at the debit side. So here the year is 2022, the month is March, and March 1st, balance brought down from the month of February is 230,000 shillings in cash and 4,756,000 Kenya shillings at the bank. So those are the balances which I brought down. So the amounts there, as you can see, they are indicated in thousands. So for purposes of fitting into that table, we have them in thousands. That's why I've read that figure as 230,000, and the other one as 4,756,000 because of the 3 zeros up there indicating that the amount is in thousands. So on second, there is money which is received from Arken. Arken is a debtor. He was owing us 140,000 Kenya shillings, but we allow him to pay 133,000 because we have allowed the discount to this debtor, and the discount is 7,000. On the same date, Mwaura paid the business through the bank 209,000 Kenya shillings after deducting a discount. In other words, he was allowed a discount of 11,000. R. Hutton paid 285,000 through the bank, and he was allowed a discount of 15,000. Aluch gave us a loan of 1 million Kenya shillings. H. Mura paid 74,000 Kenya shillings. That is also a debtor, and he deducted 3,000 shillings as cash discount. In other words, the business allowed him cash discount of 3,000, which he did not now pay to the business because it is discount. Then on 18th, Monkey R paid 247,000, having deducted 13,000 Kenya shillings as discount. On 18th, Wilson and Sons paid 323,000 Kenya shillings, having deducted 17,000 as discount. So 17,000 Kenya shillings is discount allowed to this debtor called Wilson and Sons. On the same date, 18th, H. Njoroge paid through the bank 437,000 Kenya shillings, having deducted discount of 23,000 Kenya shillings. Then on 21st, there is something which happened there. There is a contra entry. Money was drawn from the bank to cash, amounting to 350,000. And the last transaction which affected that side is the transaction on 31st, where we received a commission of 88,000 shillings. Now let us look at the credit side. That is transactions which took away money from the business. So on 4th, rent was paid through the bank, 120,000 Kenya shillings. On 8th, N. White was supposed to be paid, and from the figures you can see the amount we owed that supplier is 360,000, but we were allowed to pay 351,000 and retain 9,000 shillings as discount. So in this case, it is us now receiving discount. On the debit side, it is us allowing discount. In other words, we are allowing our debtors to pay less, deducting discounts. So on the debit side, we are discount allowed. Now we are dealing with the discount received on the credit side. So we are allowed to retain 9,000 shillings as a discount. Then on the same date, 8th, we paid a supplier called People, and the amount we paid him is 468,000 Kenya shillings, having deducted 12,000 discount. In other words, now we retained the 12,000 and we only paid for 68,000. 12,000 is the discount we received from that supplier. Then on 8th again, we are having a supplier whom we paid 780,000 Kenya shillings, having deducted 20,000 discount. So the supplier allowed us, or gave us, or we received discount at 20,000 Kenya shillings. Then on 10th, we paid motor expenses 44,000 Kenya shillings, and we paid in cash. Yeah, on 15th, we paid wages 160,000 Kenya shillings, and we paid in cash. On 21st, money left the bank, that is a contra entry, and went to cash. So the description there is cash, meaning money is going to cash. So that money didn't leave the business, it only changed accounts from bank to cash. Then on 24th, there is drawings. Drawings refers to money taken away from the business by the owner for his personal use. So money leaves the business because the owner and the business are two separate entities. So when the owner decides to take away money for his personal use, we record the money as drawings. So drawings were made on 24th, and the amount is 120,000, and it was made in cash. Then on 25th, we paid a creditor 133,000, having deducted 7,000 shillings as discount. Then on 29th, we paid fixtures 650,000 through the bank. Now, just like we did with the two-column cash book, we balance, and we only balance the columns for cash and bank. The columns for discount are not balanced. Reason being, discount allowed and discount received are not related in any way, because discount allowed is or relates to debtors, and discount received relates to creditors. So the two discounts cannot be balanced off because they are not associated in any way. So we simply find the totals of discount received and the discount allowed. So the total for discount allowed is 89,000 Kenya shillings, and the total for discount received is 48,000 Kenya shillings, and they are left like that. They are not balanced at all. So there are no balances which we take down or we carry down to the next month. When we are considering the next month, we will start again looking at the discount which we received that month and the discount which will be allowed for that month. So we don't carry balances for discount. But for cash and bank, when now you find the totals, you will realize that the debit side is bigger than the credit side. For cash, it is bigger by 123,000, meaning if you went to that business, you will find 123,000 Kenya shillings at the cash till. You will count. And if you went to the bank, you will find 4,893,000 Kenya shillings belonging to that business. So that those are the balances which we are carrying down to the next month. So those are the balances we take from the debit side, we put to the credit side so that the figures will balance. And now the figures will balance at 508,000 Kenya shillings for cash and 7,552,000 Kenya shillings for bank. So that is how we prepare the 3-column cash book. Then we are having the third cash book, which is called the petty cash book. So the petty cash book is a record of all the petty cash vouchers raised and kept by the cashier. So the petty cash vouchers will show a summary of expenses paid by the cashier, and this information is listed and classified in the petty cash book under headings of the relevant expenses. And the headings may include things like postage and stationery, traveling. We have things like cleaning expenses, printing. We have things like motor expenses and many other small expenses within the business, which may be too small to be included in the mainstream ledgers. You cannot keep opening ledgers for each and every small expenditure taking place within the organization. That is why we lump them together and we prepare a petty cash book to control such small expenditures. So they are small expenditures, but we need to keep track of them. That is why we prepare this petty cash book. When we are preparing the petty cash book could be prepared based on an imprest system. Imprest system is a system of accounting which operates on a simple principle that the cashier is refunded the exact amount spent on expenses during a particular financial period. For example, if an organization is operating on an imprest system of 500 shillings, the cashier will be given 500 shillings at the beginning, let's say, of a month. So at the end of the month, if the cashier has spent 350 shillings, the cashier will be reimbursed the 350 shillings so that when he starts the next month, he starts with that imprest of 500 shillings. So that is what we refer to as imprest system, where you keep reimbursing the same amount that the cashier has spent over a particular period of time. So let us look at an illustration. So the following is a summary of petty cash transactions of Bravo Limited for the month of May 2022. So day 1, received from the cashier 300,000 shillings as petty float. So that is the petty cashier who has received from the main cashier 300,000. Then on 2nd, postage 18,000. On 3rd, traveling 12,000. On 4th, cleaning 15,000. On 7th, petrol and delivery van 22,000. On 8th, traveling 25,000. On 9th, stationery 17,000. On 11th, cleaning 18,000. On 14th, postage 5,000. On 15th, traveling 8,000. On 18th, stationery 9,000. On 18th again, cleaning 23,000. On 20th, postage 13,000. On 24th, delivery van, that is 43,000. On 26th, petrol 18,000. On 27th, cleaning 21,000. On 29th, postage 5,000. On 30th, petrol 14,000. So what is the requirement? Rule up a suitable petty cash book with analysis columns for the expenditure on cleaning, motor expenses, postage, stationery, and traveling for Bravo Limited, which runs an imprest system of 300,000 Kenya shillings. So here, what we are talking about is that, you know, even this petty expenditure, there are so many. So sometimes we are forced to group them. So here you are told to prepare a petty cash book, which will group all those expenditure into the headings which have been given there. And the headings are cleaning, motor expenses, postage, stationery, and traveling. So how will the petty cash book look like? The petty cash book looks like that. It has ideally what we call 4 columns. Let me explain the 4 columns. The first column is the receipts column, where we indicate the amount we have received. The second column is the details column, which explains the expense which was paid by the petty cash. Now the third column is the total column, the amount spent for that day. Now what I'm calling the fourth column is a combination of columns which are headed by various expenditures. So in this case, the fourth column will be represented by those columns which are headed by cleaning, motor expenses, postage, stationery, and traveling. You can have as many columns as you've been instructed to have. So in this case, we were instructed to have only 5 columns, that is cleaning, motor expenses, postage, stationery, and traveling. So all the expenditure throughout the month will be modified to fit into those headings. So whatever expenditure which has happened, you fit it into only those 5 headings. Let us see what happens. So at the beginning of the month, that is on 1st of May, balance brought down 300,000. That is on the receipt side. You've received money as a petty cashier. On 2nd, money is paid to what? Postage. It is the only expenditure for that day. So total is 18,000 Kenya shillings. And it is recorded both at the postage column and at the total column. On date 3, there is money used for traveling. How much is that? 12,000 shillings. So it is recorded in the column headed by traveling, and the total is brought to the total column. On date 4, there is cleaning. The amount is 15,000. So we go to the column headed by cleaning, we record 15,000, and that total is brought to the total column. On date 7, we have petrol. Petrol, if you look at the headings up there, there is no heading which is written petrol. But petrol is an expenditure which is associated with motor vehicle. So you look at the columns up there and identify the column where all which will fit the motor vehicle. In other words, the use of petrol. So the expenditure for petrol will be recorded under motor expenses, and the amount is 22,000. So we record 22,000 and we transfer that to the total column, 22,000. Then traveling, the amount is 25,000. We go to the column headed traveling, we record 25,000, and we bring that amount back to the total column. Number 9 is stationery. So we go to the column headed by stationery, we record 17,000, we bring the total back to the total column. Number date 11, cleaning. So we take 18,000 to the column headed cleaning, we record 18,000, and we bring the total back to the total column and we record 18,000. Then date 14, postage. We go to the column headed by postage, we record 5,000, and we bring that total to the total column and we record 5,000. On date 15, traveling, we go to traveling column, we record 8,000, we bring it back to the total column, we record 8,000. Date 18, again, we have cleaning. So we go to the column headed cleaning, we record 23,000, we come back to the total, we record 23,000. Date 20, we have postage. So you go to the column headed by postage, you record 13,000, you come to the total column, you record 13,000. Then we have date 24th, motor services, that best fits motor expenses. So you record 43,000 there, you come back and write 43,000 in the totals column. 26th of the same month, petrol, you go to the motor expenses, write 18,000, come to the total column, record 18,000. 27th, cleaning, you go to the cleaning column, which is the first column, record 21,000, bring the total back to the total column, 21,000. Then 29th, postage, you go to the postage column, record 5,000, bring the total back to the total column, record 5,000. Lastly, on 30th, petrol, 14,000. So you go to motor expenses, you record 14,000. Then you bring the total back to the total column, you record 14,000. Having recorded all the transactions, find the totals for each column. Once you have found the totals for each column, you will realize that the cleaning column will total to 77,000 Kenya shillings. The motor expenses column will total to 97,000 Kenya shillings. The postage column will total to 41,000 Kenya shillings. The stationery column will total to 26,000 Kenya shillings. And the traveling column will total to 45,000 Kenya shillings. So if you calculate the totals of all the columns, you will realize that the total will be 286,000, which is now the same thing you will get if you added the whole amount in the total column, 286,000 Kenya shillings. So at 31st or at the end of the month, you need to balance that account. So the balance carried down. So if you've found the total as 286,000, if you found the total as 286,000 and you are given 300,000, definitely there is some balance you are remaining with as a petty cashier. So what happens at the end of that month, if you are operating an imprest system, you are reimbursed the amount of money you have spent throughout that month. And how much are you going to be reimbursed? You are going to be reimbursed 286,000 Kenya shillings. So when you are reimbursed 286,000 Kenya shillings, what will be the balance you are going with in the next month of June? You are going with 300,000 Kenya shillings, because the 286 which was spent is now reimbursed. In other words, you receive the money back to have your float of 300,000 Kenya shillings. So that is how we balance it off. So the balance carried down is 300,000 Kenya shillings. In other words, on 31st, you will receive cash, which is equivalent to 286,000 shillings. You add to the balance which was remaining with you, and now the balance to be carried down to the next month is 300,000 Kenya shillings, which is the float, which is the interest, which is kept by the business. That is how we prepare a petty cash book. Let us look at the last book of original entry, and that is the general journal, or the journal proper. This is the book of original entry, which records information that is not recorded in the other books of prime entry. It explains the type of entries that will be made in the ledger accounts, giving a reason for these entries. The types of transactions which are usually recorded in the journal proper may include, number one, writing off an asset from the accounts. For example, when you write off bad debts, when you write off bad debts, you have to record that transaction of writing off bad debts in the proper or in the journal proper. The second transaction which will be recorded in the journal proper is the purchase or sale of an uncurrent asset on credit. You are buying a motor vehicle on credit, or you are selling motor vehicle parts on credit. Such transaction will be recorded in the journal proper. Then there is correction of errors. In case you realize there are errors in accounts, what you do, you record such transactions in the journal proper, because this is now the journal which every transaction, there must be an explanation, a description. So the journal proper is used to record transactions which do not fit in any of the 5 books of original entry which have been discussed so far. So it records all those transactions which do not fit in those accounts, especially transactions relating to sell, purchase of assets on credit. And in this case, we are basically talking about fixed assets, because when we talk about current assets, when you buy them or sell them on credit, we are basically talking about purchases journal and sales journal. But when we are talking about purchase or sale of an current asset on credit, that will have to come now here in this journal called the journal, the journal proper. Let us look at an illustration. If on January 8th, 2022, a business purchases a motor van costing Kenya shilling 600,000 on credit from Bravo Motors, the transaction is recorded in the general journal. That must be a correction there. It is general journal, not general ledger, but the general journal as follows. So the format for the general journal, it has the column for date, it has column for details, it has column for folio, then it has debit, the account to be debited, and the account to be credited. So how will we record that transaction? That transaction will be recorded as follows: January 8th, then in the details column, motor van account, and the motor van account is the account which is receiving, so it will be debited. So you go to the debit side, you record 600,000. Which account is losing, or which account is credited? The account which is credited is Bravo Motors account, which is now credited with 600,000 Kenya shillings. Then the description follows. What is the description? Being purchase of a motor van on credit from Bravo Limited. So when you are going through the general journal, you will understand the transaction that the motor van account was debited with 600,000. Then Bravo Motors was credited with 600,000 shillings, and the transaction involved here was a purchase of a motor van on credit from Bravo Limited. So having looked at the cash book and the general journal, I think now we are good when it comes to issues related to books of original entry. I would like to thank you for learning with me, and I'm encouraging you to subscribe to this channel so that you can keep getting more videos as they are uploaded into our channel. And it is going to be interesting. If you have a question, if you have a query, you can drop that as a comment to our channel, and we will be glad to respond to your queries. If you have an issue you would like us to talk about, just drop that in our comment section, and we will pick the comment and we will prepare a response to all your queries. Thank you very much, and God bless you.